Good evening and welcome back to Be Rich. After Bahrain, my team had a brainstorming session. The idea was where to do an event. So we thought we had done enough in Gulf and we'll take a switch. So the team decided to do an event in Singapore. We are going to do an event in Singapore in the last week of August. Those desirous of meeting me in Singapore can send a WhatsApp to the number given below or drop a mail. My team will be in touch with you.
Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog/newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu. And these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about the markets, as we always do or usually do. And this time it's going to be a topic on where columnist on The Economist thinks that the market is heading and some of the reasons why they think the way they do. The title of the article is Stocks Are on an Astonishing Run, Yet Threats Lurk. And it's available on The Economist for those of you who are interested. Anyway, so the author starts off by acknowledging that yes, stocks have performed very well all around the world, especially in America, Europe, Japan, and even India. So we have been setting record highs over the past year, and this has been quite a good time to be invested in equities. And I could not agree more because, yes, the US markets have performed very well due to the Magnificent Seven, as we have detailed in the Substack article. And generally as well, we see that there is quite a bit of steam in most stock markets around the world, even in Europe and in India. For those of you who had invested before this year, you would have seen great returns on most of your investments with not doing anything this year. So, that being said, there is one outlier, China. And we did talk about China before on this channel, and China has not been performing very well in its stock market. But enough about China. Let's look at other emerging markets. And we see that the MSCI, emerging markets companies, apart from the Chinese ones, have done quite well, and the rest seem to be gaining and going in an upward trajectory. So the emerging markets have been doing quite well, apart from your giants, which are America, Europe, and Japan. So some of this gain comes from the way indices are structured. So what indices do is that they periodically drop the losers out of the index. So suppose your market share is dropping and you have a set very stringent requirement which you have to meet. You have to be a performer. Your stock has to be doing quite well. And there are a few other requirements on market capitalization size. And if you fall well below this, then you will be kicked out of the index. And other performers, and once you were kicked out, you'll be making room for other performers who are currently not in the S&P 500, will be entering the S&P 500, Nifty 50, or any other major index around the world. And finally, these are floating market capitalization based indices. So the performers are valued more and more and more, and the component, the weightage in the index keeps going up, and more of the passive inflow. So when we say index passively, most of your passive money goes into these large weighted companies, and the performance keeps going better and better because there is now more money being flowed into them. And this is a feedback loop.
True.
So indices have a positive bias. We need you to remember this. And if you look at what is happening through this lens, you will see that there's a huge amount of money which is flowing through passive index funds and through active investors, especially to companies like Nvidia, Amazon, Microsoft, Apple. So yes, the S&P 500 has done quite well. Global stocks since 1900, the year 1900, have delivered 5.1% every year on year. This might seem like a shockingly small number, but do remember that in the past, before the gold standard was abolished, inflation rates tended to be more under control, and we basically saw that central banks could not print how much ever they wanted to. So there would be periodic deflations. So the real return would be quite positive during these times as well. But today we have free-flowing currency, so we don't see 5% as a big deal. But if you actually look at it, 5% on a real basis is quite good. And the American stocks have delivered 6.5% over this period as well, year on year, which is a very good return. But there's a hint of survivorship bias here because, as I said before, the losers are dropped out of the index. So you don't have an accurate picture of how the entire market has done.
The broader market,
because the losers are always kept out of the picture, the ones who went to zero or even less than zero.
Yes.
That is, there was debt in those companies. But regardless, there is no denying the American companies have performed quite well since the 1900s. Okay, now let's talk about what is happening today. Today, we see that through different measurements, pick your fundamental value measurement, be it PEG ratio or be it your PE ratio, forward-looking PE ratio, which again is a little muddled. But anyway, take your forward PE ratio or the ratio which I like to look at, which is called the CAPE or CAPE, which was invented by Robert Shiller, who's a Nobel laureate. And he is a wonderful economist, and he came up with cyclical price-adjusted price-earnings ratio, which is a long name to basically state that this number looks at 10-year averages. So if you look at the real earnings in averaged over 10 years, and you look at the price of American stocks today, so you smooth out corporate profits, you basically see that the valuations haven't been this high since the dot-com bubble. And this is very alarming. This is very alarming because the dot-com bubble was something which is very similar to the bubble we see today, with maybe using the word bubble in a conservative sense. Because we see that Nvidia and the rest of the Magnificent Seven are technology companies who are commanding wonderful prices based on the story of AI. So if you look at the story of AI and you look at the dot-com bubble, which had the story of the internet blowing up, you see that there's a lot in parallel. The CAPE ratio is also telling us that, these numbers are very high. And it indicates what seems to be a bubble. Right. And if you look at the inverse of the CAPE, you'll see that there is something known as a CAPE yield. So like how you invert the PE. So before in PE, you put price divided by earnings. And if you put earnings divided by price, you'll see the return on the certain price you have. In the same way, if you invert the CAPE ratio, you get the CAPE yield. And if you look at the CAPE yield, it's very, very close to treasury inflated protected securities. So these are treasuries which have an inflation protection built into them. And the yields which these securities are giving today, the CAPE yield is very similar to that. This is alarming because equities are supposed to give you much more than what treasuries give you, because equities are considered riskier. Treasuries are a risk-free form of asset. So for the risk which you're taking in buying equities, you should be asking for a higher return. But today the market does not seem to be asking for a higher return. So it may make more sense for us investors to put our money into treasury inflated protected securities for a while and look at equities when it does actually offer us greater returns. And when these two yields diverge or converge is when we basically see that valuations and equities have been climbing. And this was last seen very close to the dot-com bubble when this convergence and then divergence happened, where tips yield went up and equities yield went below tips. And that's when we saw a true bubble. And something similar seems to be happening today, where they're very close to converging. And I urge you all to look up this graph online and you'll be able to find it. So this is a story about American stocks. If you look at Indian valuations, we're even worse. Well, even worse or better depending on which side of the coin you're on.
Correct.
But if you're looking to buy today, the valuations seem quite extreme. Our PE ratio for the Nifty is around 25, which is huge for an index such as us. And Japan and Europe are a little less than the US in terms of valuation, but they're still up there with the US. And India seems to be leading the pack in terms of valuations. And this is definitely a sign for us to stop, take stock of what is happening, and wonder which companies we really want to buy. Because the market seems to be piping hot right now. You need to blow on the spoon a little bit before you take your bite, is how I think about it. So, what are some... Okay, and now the next question you're going to ask me is, look, you've told me, yes, valuations are sky high and blah, blah, blah. But what is going to cause the market to reverse? What inherently built into the market or outside the market is going to cause a reversal in the trend? So, this is the first threat. I see it and the author sees it. The first threat is that there is a tail end risk. The tail end risk relates to geopolitics. no one can deny that over the past 20 years, geopolitical risk has definitely gone up. And today we see that there are two major conflicts going on, with the Ukrainian conflict as well as the Palestinian conflict. We see that they're in two crucial locations, one in Europe, the other in the Middle East. And any of these two conflicts, if they become big enough, they can definitely create a huge shock in terms of oil prices in the Middle East, and Ukraine as well will cause energy prices to go up. And this is a huge tail end risk where America might be forced to widen its fiscal deficit and be forced to basically spend more and more. And this is something which is going to cause inflation rates to go up, and it may put a brake on Jerome Powell's cutting of the interest rate. And if interest rates stay where they are, then the market may be in for some trouble. Okay, this is hard to predict. We don't know whether China will blockade Taiwan, whether America will get involved. All this is, speculation. Let's get to the second threat, which may convince more of you. There is a yawning fiscal deficit in the USA, which we talked about in the previous point. But even without a conflict, both party nominees are saying that they're going to increase spending in different ways. One, Trump is saying that he's going to give tax cuts and he's going to engage in a trade war with different countries. And two, Biden is saying that, yes, I'm going to be doing more welfare spending, and he's already talked about forgiving student loans in America. And this is definitely adding to the fiscal deficit. And adding to the fiscal deficit basically opens up the threat of revolts by bondholders, where they dump your treasuries and spike up your interest rate. And if they do that, then we definitely see something which is going to cause the market to stay at a higher rate of interest, and that might affect corporate earnings and therefore stock prices. That could be the second big reason. Finally, the third big reason, even if you say that this isn't going to affect you, this is the final nail on the coffin, which is the fact that markets have already priced in crazy high earnings growth in corporate earnings. And they've also factored in double-digit growths in Nvidia's and other chip-making companies' growth in revenue. And if this is the case, and they have a very ideal scenario in mind where they've already priced in 3 rate cuts in treasuries, and if this is to be the case, and suddenly any of these different factors, be it Ukraine, be it a greater fiscal deficit, be it not able to borrow more or borrowing more, any of these could lead to something which the market has not predicted. Just a simple two-phase earnings report which doesn't grow at the rate which the market expected could lead to the market melting down, because they've already predicted such high rates of earnings, both in normal common stocks as well as our Magnificent Seven, that anything which deviates from the norms in a negative way could lead to the bubble to pop. And this is the phenomenon of the dot-com bubble as well, which it popped not due to any seismic event, but one day people woke up and realized that, look, I think we've gone too far with this bubble. Let's get out. And everyone rushed for the exits at the same time. And we saw that the market basically collapsed due to a huge stampede. I'm not saying this is going to happen. No one knows the future. But as an investor, as an intelligent investor, it is important that we have to keep these factors in mind. So what do you think about this situation?
Well, this leads to an interesting proposition, meaning taking all this into consideration, this index being so heated, like you said, only the winners being allowed in, losers being taken out, and the market is overheated. What do we do with the information? Do I invest now, or do I hold out investment? So the interesting thing would be, there's two ways to look at this investment. One is lump sum investing, the other is sipping. If you are a person who's sipping, all this doesn't matter to you, because whatever, even if the market collapses, you'll be sipping. As the market recovers, you'll be sipping. So all the losses and gains will average out. So even if you start sipping at the height of a market, at the pinnacle, you start sipping. If you see how, take past numbers and look at it, study it. Let's say you take S&P 500 and use that to study. During the dot-com, what he suggested, dot-com time, you see how long it took to recover. You would have recovered very fast if you've been sipping periodically. The problem would be is, let's say you have a lump sum. You have some 10 lakhs, 20 lakhs, and you deposit it, plonk it into a mutual fund passively and say, okay, I'm putting a lump sum so I can not worry about it for the next 10 years. Then you may have a problem. Because let's say this is the height of the market and we have a severe correction like what we had during the dot-com, followed on by another recession of sorts. Then it could even take 13 years for it to come back to where it is. And it might take another few more years after that to see returns of 7-8%. That is where the problem lies. So All this information, what I would suggest, the main thing you should keep in mind is keep, like Anand says, at different coffee ranges. Stay within your circle of competence. Don't get attracted by something which is exotic. Don't drop all your currency in the market at one go. Hold on to it. Keep sipping. Though the market may be very attractive, stocks may, certain companies you've been looking for some time might be very attractive, might even be at an attractive price. I would still say keep sipping at it. Do not go and drop all your coin on the same day just because you saw it correct. Unless you have the stomach to wait for 15 years if something turns bad. And like I was saying before in another video, sometimes the most inconsequential news creates markets to jitter and starts a negative feedback loop. And once a negative feedback loop comes in, it's very hard for the market to break out of it till it bottoms out. And sometimes a negative feedback loop can be very specific just to one market, one share, one sector, and may not spread. Like you may think it has to be a global catastrophe to happen for the Nifty to collapse. Not at all. It can be something very small and specific, even to something happening to one single company in the Nifty 50. And that creates a panic, and investors lose confidence and can have a domino effect spreading like a virus throughout the whole system. And you won't even know why. You'll be sitting there wondering, nothing has changed fundamentally. Why is everybody selling? That's what panic is. And it can happen. I'm not saying it will happen. I'm just saying it can happen, and you should have the stomach to bear it if it does happen. And to see a market upshot from here, like he's saying PE is at 25, to maintain this PE of 25 or even expect another 15% growth from here, you have to have phenomenal earnings. Even with IMF saying Indian economy is going to grow at 7%, boy, we need more than that to justify these kinds of cost and growth which you're hoping for. That's what I feel.
Anyway, so thank you for watching this video. We hope that you got some value out of this. And if you like this video, please like this video. Please share it with your friends and family members if you think they can get some value out of it. And please leave comments on what you think about the video. We'd love to read them, and we'd love to hear other future video topic suggestions. Thank you again for coming to Be Rich.
Thank you.
It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.